Hello, everyone. Welcome back to the Rash Investors School for Trader Development. Dun, dun, dun. It's actually kind of weird with these level 2 and level 3 programs this term being 2 weeks apart. I haven't actually seen you guys that much recently, so I hope you guys are doing good. Some of you veterans, it's just absolutely beautiful to watch you guys in the market acting. It's like, you know, we cheekily call this level 3 God mode. But I got to tell you, man, some of you guys watching you guys in the market and even just seeing you, the way your demeanor is and stuff on the site, you guys are in God mode. It's incredible to watch some of you guys in action. Just beautiful. And hopefully, you know, the relative anxiety level about participating in the market, you feel calm, you feel relaxed, you know, you're not always going to win, don't get me wrong, but at least your relative anxiety level is much less than when you first came to work with me. So welcome back to class. And like I said, I haven't seen you guys in a little while, so I hope you're doing okay. We're slowly working through the sort of, let's call it, what's the best expression? This is the kind of conversation that I don't even want to have with people who are new to investing because it's almost impossible to talk to them about this stuff. At the same time, too, there's a lot of really powerful, important information that we can take directly from derivatives from the market. But because they have this inherent possibility of basically expiring worthless, this definitely is not a conversation you want to have with somebody who's like just right off the street, doesn't understand risk management, doesn't understand the different risk takers there are and how different, you know, traders act in the marketplace. And as I had sort of said a moment ago, it's great to watch all of you just, you know, participating in the market at your own leisure, doing it at your own pace. I can see that you have the confidence, the calm, the demeanor to even be able to have this kind of conversation with me. At the same time, too, you know, derivatives unto themselves is a fairly steep learning curve. A lot of terminology and a sort of a change in the way that you perceive the way assets perform in the marketplace, this whole concept of delta, and the way options prices behave given their relative position with the underlying and their strike price. I hope this has been educational for you. It might be a bit overwhelming, and that's completely understandable. The purpose of this program was to give you a very basic sort of overview of the derivatives industry. Make sure you understand the basic nomenclature, and give you at least, you know, a good half dozen or so strategies for you to seriously consider and analyze going forward. And then also to give you a few different tools and ways that we can use derivatives information, regardless of whether you take the trade or not, to help you understand context in market state. So with that said, we're coming up to sort of the tail end of this 4-module introduction to derivatives. As always, it's not a bad idea just to start off with a little bit of review. And so, you know, get your notes out if you want. I want you to make sure to get these answers correct. If we ask a question in this review and you don't know the correct answer, I would strongly suggest that you write out the correct answer 3 or 4 times in a row. Just below, you know, not a bad idea to have a journal out while you're going through these classes. So where shall we begin? And actually, I think was it Thomas? Was it you and I who did the real estate deal? And then I think you were absent last week. And so we substituted Jeff in for your seat. It was nice seeing Jeff again. And just FYI, that Jeff guy, he now drives around like a $200,000 Jaguar. Thanks to everything that he learned at TRI, he's doing very well for himself. When he showed me, he's like, "Look at my ride! Woo! I made it!" He blew all his profits on a car. Oh well, what do you do? But what the hell, eh? He always wanted that car, so he got it. What do you say, Keith? I reckon Brian's broken contract with the changes in house sale. Oh, okay. Yeah, well, that's so that's what it is. That turns out it was a naked something on one of our parts. Anyway. Okay, so let's go back to our nice little illustration. And you know the irony of it all, like when I was an options broker, the more complicated people try to make this conversation, the harder it is for you to remember it. But what did you think, guys? Is our house analogy, our example, is it a fairly easy way to understand options? That's the whole point of it, is they don't actually have to be really difficult. But of course, the talking heads, and then of course all the financial institutions that would like to keep the public out of the conversation, they're going to throw, just ridiculous terms and crap at you. They're going to throw spreads at you right away, just to try and confuse you and just keep you in the dark as a member of the public. But if we think about our house analogy, it's actually extremely simple stuff. So we had said that Thomas was thinking about buying an additional house, and I was thinking about moving down south because I'm getting older and I want to retire. So in our transaction, who is the writer of the option? Kevin got it. That's right. I am the writer of the option. If I own the house that I'm writing this option for Thomas for, what do we call that transaction? If I own the house, well, yeah, exactly, a covered position. Excellent. And if I don't own the house, and I'm doing this a little cheeky, what do we call that? Pantless, nakedless, shoeless, naked. That's what we're looking for. All right, now, we had said that prevailing real estate prices in our neighborhood were like $100,000. And I'm not really out to make a fortune on the deal. I just want to sell my house for $100,000. So what do we call that $100,000 mark that gives Thomas the right to buy my house off of me at that specific price? What is that called? The strike price. Very good. Now, for that right, Thomas had to pay me something, didn't he? What do we call that payment? The premium. Very good. Now, let's see if we can do some math here. If real estate prices do go up substantially, who can write out the mathematical equation to figure out what Thomas's profit margin is on his transaction? It should be this minus this minus this. Current price minus the strike price. Good, but I think you forgot something, Kevin. Current price minus strike price minus premium paid. That's right. That makes sense, Kevin? And, I only see 2 people answering this, so what should the rest of you be doing? I would like you to try and at least answer these questions. Good. Okay, so in our scenario, if the town council met and it turns out that they decided to put in a golf course in the neighboring property, and real estate values go shooting higher, What does that make Thomas's option? Is it at the money, in the money, or out of the money? In the money. Very good. In the money, right? Whatever the prevailing market prices are minus your strike price. If prevailing market prices are higher, then that means that option must be in the money. In our town council meeting, actually, why don't we back up? Let's say that prevailing real estate prices were, I don't know, $90,000 or whatever at the time, $95,000, whatever. And this was a $100,000 strike price, and Thomas paid me $5,000 premium. Who can tell me what the intrinsic value of that option is on the day that we did the deal? Prevailing real estate prices are $90,000. The strike price is $100,000. What is the intrinsic value? It is 0. Very good. So what does that mean that that premium must be made up of? Since there's no intrinsic value, what are the other types of value that go into that option? Time. Very good, Warwick. Intrinsic value, or is that what IV you mean, Greg? What IV do you mean? Implied volatility. Ooh, nice. So, is there a name that we give to that time value? Is there some sort of theta? Very good. Nice guess, Warwick. Vega is incorrect. Theta is time value. And will theta values, will they go up or will they go down as time passes? Will theta values go up or down as time passes? Well, no, theta actually will go down, Ian, right? If anything, if we pop back on over to the material, I would strongly suggest that you sort of commit this image to memory. And actually, the follow-up to that is that rate of change linear or is it logarithmic? Oh, log, that's right. If we actually look at the what we call the time value decay, oh, I don't have it on this one. Surprising. All right. If we look at the time value decay, what actually ends up happening is it starts to accelerate as we get closer and closer and closer to expiry. And so this rate of change is a logarithmic rate of change, not a linear, until it gets to the point of 0. So if this is the case, then would writers of options be best served to write long-dated options or to write short-dated options? Short-dated options. That's correct. Why? Because they would like to ideally take advantage of this exponential growth in the collapse of theta as we get closer and closer to expiry. And conversely then, buyers of options, should they be considering buying options near expiry? Is it really in their best interest? No, it isn't. Buyers of options really should concentrate at least, you see how this is just in the last 120 days. So, and this is why it's really important when we do our options analysis, if we're thinking about being long, that we concentrate on these options way out here. And the more time you buy, the better. What are you saying there, Ian? But why do they do it, i.e. buy it? Well, it really all depends on what your participation is. You could buy, yeah, I mean, you could be buying a short dated option just to try and make sure that you're completely hedged. And if you're buying an at the money option, because the implied volatility premium is supposed to do nothing more than just replicate the margin requirement on a short position, does it make sense that if you have a position on here and you've calculated the Black-Scholes model and it says that the value of the option doesn't have a heck of a lot of time value on it, but it's equal to the margin requirement of the futures contract, and let's say you only wanted to have the position on for a few days, you could consider buying that $30-day option, because you're looking at it from a trading perspective, not a pure time value perspective. Does that make sense? So a lot of traders, and this is sort of the implied volatility trap, right? A lot of traders will trade options because if they don't equal that implied volatility, or the margin cost to just margin on a futures contract, then that opens up opportunity for arbitrage. But for us speculators that are just concentrating on just pure capital gains from being long options, this is a mug's game. This is dangerous. We're getting in, the statistical odds are working against you. And what usually happens, we'll actually talk about this later today through the roll, is you'll go to sleep with your option sitting up here, and then the option expires, and then now your option becomes the front month contract, and then the market just moves ever so slightly the other direction. Let's say you had a call and the market puts in an M and starts breaking down. Whatever time value, it will just like instantly evaporate. Poof, gone. And I've seen it happen so many times. It's just not worth getting involved in this part of the spectrum if you're a buyer. It just isn't worth it. I've yet to see. Now, keep in mind, Ian, we could do a spread trade, right, where you're long one contract, you're short another contract, and you're trying to take advantage of that time value decay. There's nothing wrong with that. But on balance, if we're just talking about being strictly long one contract, not a spread trade, we don't even want to participate in this part of the curve. Okay, so we talked about one of the, and what's the term that we use to describe these things, these sort of variables in options prices? There's some sort of term that we use. What's that called? The Greeks. That's right. How many Greeks are there? Anybody remember? 5. So we already covered one, theta, right? Time value decay. What do we call the, let's see if we can, what do we call the effect of a change in short-term interest rate policy by the Fed? Let's say they raise the cost of borrowing. And that obviously has to be reflected in options prices. What do we call that? A rho. Very good. And as I've said before, because interest rates are relatively low right now, you don't really see too much of an effect rho has on options prices. But when I started in the industry, interest rates were double digits, and in those days, a change, in Fed policy of 1 full percentage point, that would make a big difference in option prices and also market volatility. All right, so we talked a little bit about the time value of options. We talked a little bit about the effect of the change in short-term interest rate policy on options prices. Well, probably the easiest way to do it is just jump right in. Who can tell me what the name of the effect a $1 change in the underlying principal's assets value is reflected in options price movement itself. That sure was wordy, wasn't it? The delta, that's right. Well, delta is the term that we're looking for. And really all you got to think of the easiest way to remember delta, what does delta mean? Does anybody know what delta means translated? Yeah, change, right? Like anybody who's taken like it's been so long since I've taken an introduction to calculus, right? The derivative. Everything starts with delta, the rate of change. And you could even argue that actually measuring this curve, measuring the slope of this curve, first off, what do we call that? Slope of the delta curve. Measuring that, right? The gamma. And in essence, what is the textbook definition of gamma? The first derivative. Very good, Kevin. We got one correct answer and one no fucking clue. So the whole point here is that gamma is basically talking about the change of the slope of delta. Does that make sense, Warwick? So can you see how the slope of delta starts accelerating and moving higher here, but then it peters out and the slope of delta actually starts trailing off here. In essence, the derivative of the derivative, or the first derivative, what they call the derivative of change. And that's called gamma. So we're only missing one other Greek. What Greek have we not talked about yet? A vega, that's right. And Greg, what does vega stand for? Can you remember? I'm gonna put you on the spot now. That's right. In essence, hopefully you can see with the option strike price, and this is assuming that our strike is here. With the option strike price a million miles away from where the current underlying is, then what ends up happening is you can have 5-10 point movement in your underlying, but your option just doesn't do anything because it's so far out of the money. And yet as we get closer and closer to it becoming the strike price becoming at the money and then hopefully in the money, the option literally comes to life. Sensitivity, it wakes up. And so in essence, that wake upness is measurable. And that's what's called the vega. And any of you guys who are super smarty pantses and you want to take this to the next level, build a vega screen. Vegas, this is the secret sort of juice of options traders. It's impossible to find this information. You want a fun assignment? Well, if Brian Ayre says something's impossible, then I'm going to solve it. Somebody go and find me a reliable vega screener out there in the world, and I'll pay a lot of money for that subscription. And frankly speaking, I've yet to find a reliable vega screener. But nonetheless, it is definitely a component in sort of our options pricing model. And speaking of which, is there a name that we use to describe how all of these components put together should create sort of a value for your option? If I ask that kind of question, then obviously the answer is yes. Thank you, Kevin. The Black-Scholes model. Who's Black-Scholes? That sounds kind of funny. Well, it's just a guy named Black and another guy named Scholes, and they put it together one day, now called the Black-Scholes method. Okay, so I think we have talked about the Greeks and the definitions. The def again. Well, you know, it should be in our material here. So if we go back to, I think it's even in the introduction. Right here, somewhere around in here. There we go. So Black Skulls, we even have a nice little Investopedia reference for you, Ian. If you don't believe me, you can always pop on over. Option pricing model that tries to determine fair market value for a derivative, where price of the option equals intrinsic value plus time value plus risk-free rate plus implied volatility. There you go. Merry Christmas. You know, the easiest way to think about this, and I always say, just think of this Einstein cartoon. Time equals money. It's just that simple, really. Well, hello. Hey, Spencer. How you doing, buddy? Nice to see you. All right. So, hey, there we go. Greg's giving you, oh, look at that. And he even gives a nice YouTube video. So Greg's got a nice resource here for you. Hey, look at that. Oh, is that Black and Nash Skulls? So anyway, basically going through the whole process. I guess this is a nice video, 10 minutes long. That's not so bad. So I don't know. Actually, that face looks familiar, though. That'd be interesting. That face does look familiar, but I don't know off the top of my head. Maybe Skulls, plural. Maybe they're brothers. Who knows? Anyway, the point of the matter here, Greg's giving you another resource. Make reference to it if you want to watch it, if you want to bring yourself up to speed. Not a bad idea. I mean, I'm not going to get too much into particulars of Black Skulls because I don't really like trading at the money options. You know, the process that we went through in this course was to sort of teach you how to take advantage of options when they're at their vulnerabilities. So remember, when we're buying options, we want to buy a shitload of time, and we want to use our TRI SOF to help us determine whether the option's cheap or not. And then conversely, if we're writing options, remember our covered call scenario, we're looking for options that are trading at just ridiculous premiums. And usually that happens with stocks that have gone like straight up, and then, you know, like less than a month of time. If you can find big upside technical objectives like our pharmaceutical stock we showed you, you can do pretty well writing options and just doing the covered call strategy. Okay, so nice introduction to options basics. I think we covered, and actually you guys did pretty well. Keep in mind, obviously, all of these questions are going to be on the exam. So it's not a bad idea. Just take some time to make sure that you can regurgitate the Greeks and just have half decent notes, and you'll just walk through the exam. Okay, maybe a couple other quiz questions here before we get going. Who can tell me if you have an option and you can only exercise the option on expiration date, what is that type of option? Oh, Warwick, right out of the gate. Geez, you must have anticipated that question was coming. Am I that cliche? European expiration. And then conversely, if you have an option that you can exercise whenever you feel like, what do we call those options? American. And actually, what's important is we got Mexican. No, I don't know about that. I think we have to make sure that you use the word style after European and American. That's just the way that the terminology in the options industry. European style, American style. Okay, we introduced you very basically. I didn't go into too much detail because, I mean, hell, we could spend a whole bloody year exploring spreads. I did introduce you guys to that Tasty Trade site. I don't know whether anybody had the opportunity to log in and register for those guys. If you are interested in spreads, I would highly recommend that you explore that site. Excellent, Greg. Good, good, Warwick. All right, good. You know that Schoenstein guy. I mean, he knows his shit, and really the irony of it all is that all they're doing is they're just. What's really cool with their option spread matrix is they just literally do this analysis on every single option chart. They have a special sort of matrix that they use. Let's see if I can just find that for you. Oh God, I wouldn't even know where to look. What is it called? Tasty trades options matrix. Is matrix the right word? Probably not. Nope, definitely not. Matrix, maybe that's what they use. I don't know. Yeah, here we go. So in essence, when you look at these skews on their site, all this really is basically a visual demonstration of this concept. That's all it is. And again, if we're buying options, we want to concentrate on either deeply out of the money or deeply in the money. And if we're writing options, we want to concentrate on at the money. It's just that simple, guys. It really is. But the point here is I did want to introduce you guys to the tasty trade guys. And I'm just going to put this away for now. Although I really do like that resource. So I'll take a look at those and see whether we should add them to the course. Thank you for that, Greg. But in essence, I did sort of just lay the groundwork for, because remember we talked a little bit about, does everybody remember the Pippi spread from level 2 and introduction to futures trading? The point here is that because options have all these internal components and they have this thing called delta, so the rate of change of the option changes given where it is relative to the strike price, that leaves a lot of opportunity to do trade ideas through spreading. And in essence, all you're looking for is one option that's relatively more expensive, i.e. a higher intrinsic value, versus an option that has lower intrinsic value or is less expensive or cheaper. And you're just going to be buying one, selling the other. Because you're doing one long, one short, technically your net position is neutral. And then given, either the options volatility, all right, implied volatility ratio, or your expectation of whether the asset is undervalued, fairly valued, or overvalued, you can build spread strategies based on those expectations. And did we take the opportunity, guys, to I hope you did, but did you take the opportunity to visit like these sites and just walk yourself through the very simple tutorials on spreads? We also gave you in the course material, I guess it would be in the library, wherever the hell that is, over here. We gave you the, actually, I think I had it in the cheat sheets, didn't I? We gave you the options cheat sheet, this thing. So, if you still are in the dark about what these are, please book these damn tutorials. That's what I'm here for. And let's walk through the explanations of how these worked. Actually, I think, didn't we have an intro? I think in Bobo, didn't we do this? I seem to remember. But the long and short of it here is that this is a very, very popular way to trade the market. Yeah, okay. So I did one with you, shared with people. Okay, good, excellent, good. And, really what I needed you to do, because, we have relatively limited time here, I needed you to, introduce yourself to these just so you can walk through and understand the mechanics of how option spread trades worked. Really wanted you to take the opportunity to introduce yourself to this guy. He's a character. I mean, aren't most traders characters? Have you ever, oh, look at that, naked options. Don't want to get into that. Taste. But I don't know whether you've seen it at TRI, but do you find that most options guys are a little bit odd? I'm sure Brian probably isn't your typical market participant. I mean, we're definitely weirdos. Anyway, hold on. Okay, and I want you to familiarize yourself with both this matrix, and really, if anything, all of you should keep this in your back pocket. I could definitely ask you on the final exam if you believe that the option volatility was very high and you felt that the asset was overvalued. Can you please list some strategies that would effectively address spread trading given your market outlook? That could easily be a question on the final exam. Hint, hint, hint. Not a bad idea, but let's change the screen so you don't see the answer. If we are buying, if we're, well, I'm going to say, if we're spread trading up and down the ladder, what kind of spread trade are we doing? And I actually just sort of gave you the answer, right? Thank you, Greg. It looks like Greg's the only one interested in spreads. Vertical spreads, right? Does that sound familiar? It was just on the slide a moment ago and I took it off the screen. If we are doing a spread between, say, the September contract and the December contract, what kind of spread are we doing there? All right. I'll call it a horizontal, but also called a... No. Be careful there, Warwick. Calendar spread. Do we remember the term calendar spread? And just think about it, right? September, December, it sort of made it. It's pretty straightforward. And then finally, if we were thinking about, say, buying a call on corn and then buying a put on gold because we think that the spread is out of whack, what do we call that? And Warwick, you already had the answer written, didn't you? All you had to do is hit the enter button. Thank you, Bobo. Thank you, Warwick. Diagonal spreads. And frankly speaking, I don't see a lot of people do diagonals. It's too complicated. And you can get yourself into trouble really quickly. I would strongly suggest, especially with like guys like Schoenstein, right? They're going to I think that's his name, Schonoff or Schoenstein or something like that. What the hell's his name? Snozages? Something like that. Tasty Works? Is that what they're calling themselves now? I thought they called themselves Tasty Trades. Anyway. Shauna. Anyway. Concentrating just prior could get burnt with that easily. Well, with diagonals, yeah, it can get a little screwy because you could have like something happen to say like, in our case we're long corn and short gold, a crazy ass spread. And all of a sudden somebody shits their pants in one of these markets and the spread just goes nuts, right? So you really you better know what you're doing. I do know a lot of people in the stock market like to take two stocks that happen to be in the same sector. Like let's say like Facebook and Amazon, and let's say you figured that Facebook was overvalued relative to Amazon. Well, you could, write a call on Facebook and then buy the call on Amazon. But again, I'm not overly impressed with that kind of trading. And that's a little bit beyond what even we want to do here. So primarily, we're going to be concentrating on verticals and horizontals. Okay, so the quiz question that I had for you coming out of that material was we asked you what kind of different spreads you could do. So it's important to understand that. And we might ask you, really, and just have this image handy. I might ask you, given this outlook, what are some appropriate strategies? Okay, we then moved on, and we introduced you to some very specific strategies. And Spencer, I don't know whether you ever got this. Did you? I was going through my files, and I actually found this was written, I think, in like about 1985. But I actually found the original silver options insurance plan write up from the guy that I learned this from years and years and years ago. Spencer, are you here? I don't know. He's our alumni here today. So if you didn't get this, I can give you these links. Really cool document to keep in your tool belt. So, by all means, I wanted you to familiarize yourself with this idea where we can buy a number of options where if we take the cumulative delta and add them all together, we can replicate ownership of the underlying, but have it and do it through multiple contracts. Does that make sense, guys? Did anybody have any questions before we move on with the Silver Options Insurance Plan? Anybody have any questions about the mechanics of how this strategy worked? No? It's legendary. That's cool. All right. Definitely could ask you a few questions on the final exam. Yeah, well, I would suggest, and the good part about it here, Ian, is now that you guys are basically level 3, you're grandfathered on the site. As you see, Spencer, all of you are going to be, invited to come back to any class in the future. I don't expect you guys to be trading options right away. This is a pretty steep learning curve. If it takes 6 months, a year or so for this stuff to settle in, keep in mind, this strategy, this was written up like fucking 30 years ago, right? And nothing's changed. If anything, it's gotten a lot easier because remember when we went through Ken's case, he could only buy like 6 months out in time. With, the modern ETFs, we can go and buy like a year or two with leaps. Oh, that's a quiz question I didn't ask. Okay, so I will twist it around. Let's see if anybody can get this. Who can tell me what the term leaps actually stands for? That's a tough one. Warwick, you say you type pretty fast, so let's see if you can type all that out. No, you're not even going to give it a try? Now, come on. Each letter means something. And I know I've said this specifically in class, but anyway, for the record, everybody write this down. Long-term, equity, asset, participation, securities, leaps. Frankly speaking, I don't even think the name has anything to do with the actual. They just wanted to figure some way of not having to use the word derivative. Long-term, L, equity, E, asset, A, participation, P, securities, S, leaps. Long-term, equity, asset, participation, securities. There you go. Well done. Now, you want to impress the chicks at a cocktail party? Pull that one out. And don't have Spencer standing beside you because they're just going to go, fuck you, I'm going with Spencer. Have you ever seen Spencer's? Look at his picture. Yeah, exactly. I don't even know if Spencer's even here right now. Anyway, I'm off topic here. Okay, so I wanted to basically show you how we can use options derivatives to leverage returns in the markets. And this works really, really well. It's worked so long that the guy that I first learned options from 30, 40 years ago, he learned it from guys that, what's really interesting is if you actually read up on W.D. Gann, he was trading options back in like the 1910s and 1920s. It's just that they were OTC and extremely risky. The advent of, they go all the way. It's cool when you actually go and read Gann and him talking about buying like a $2 wheat call option. It's like, wow, that's so weird. But you got to understand, in those days, they were all OTC. Now, what's the problem with OTC options? It's kind of like what's going on in Bitcoin in a weird sort of way. That's mad and risky. No clearinghouse. Right. But does it make sense? And very good answer, Warwick. Does it make sense that if you're as big a player as like a guy like Gann, $1 million accounts, whatever, the trading houses want his business, so they're not going to fuck him around. So I thought that was just really interesting. So, okay. The next long strategy that I would like for you guys to try and incorporate into your thinking, because it works as an excellent unrelated reason to consider taking a trade, is the TRI's secret options formula. Who can write out what this secret options formula is? Strike price minus target price equals 2 times current market price for option. Excellent. Very good, Bobo. Perfect. And Bobo, have you been searching around the market for any of these ideas? Have any jumped out at you? Excellent. Good. Again, you don't necessarily have to take the option trade, but it is such a great tool to, how do you say this? Make it a prerequisite that I can't participate in this market until the implied volatility has come out of the options prices. Because remember, in options, that's the key. Most of the time, options trade with horrendous implied volatility, and they're staggeringly overvalued. This is a great little tool for each and every one of you to just simply go and say, well, are the derivatives suggesting this is a good idea? Yeah, it keeps you honest. Excellent way of putting it, Warwick. Did anybody have any questions about the TRI SOF? Oh, we lost Spencer. I guess he was so insulted. Shitty. He probably had some like really hot chick just standing beside him or something. If you watch this later, Spencer, don't yell at me too much. All right, we'll keep moving on. Where should we go next? We wanted to move on after we sort of introduced you to basic long strategies, and we wanted to introduce you to short strategies. That's kind of what we did last week, or I guess last time we were together. We did short strategies. I don't really recommend short strategies to most people. And of course, there's an inherent danger in shorts because it's very, once you get approved for actually writing options, this is just basically an income generating machine, and you just get paid money for writing these options. Boom, big check handed to you. Merry Christmas. So as a result, you can get complacent. Geez, just pulling in all this money week after week, month after month. This is too easy. Does anybody remember, was there a University of Economics professor that almost destroyed a brokerage house because of how easy it is to write naked options? Hopefully everybody remembers my story. Does anybody remember the firm that I was working for? I think I told you the name of it. If you remembered the name of the firm, then I would be damn impressed. No. That was a prop firm I was working for. No, the firm that I was working for, it was Art Smolensky's outfit called Global Securities. Anyway, Smolensky is a character in the brokerage industry in Canada. Probably not even really heard of outside of Canada. Okay, so we wanted to introduce you to the other side of the equation. And remember, buyers want to concentrate here. Sellers, writers want to concentrate here. Buyers want to concentrate over here and here if you're going to buy in the money options. Sellers want to concentrate here. And then, of course, the Vega right? Buyers want to concentrate on options that aren't very sensitive. They're not really moving much. Sellers want to concentrate on options that are trading at just stupid, ridiculous valuations. The easiest, the most profitable, the simplest strategy to take advantage of this concept of Vega and implied volatility expansion is the covered call. And hopefully, did anybody have any questions about how this option was trading at such a ridiculously high valuation considering how far it is out of the money? Do you see that, with basically a month of time, this is July and it expires in August, this option, if you just simply went and bought the stock in the marketplace and wrote the option, you're basically implying a nice, if you actually had the stock called away from you at 55, well, technically your profit margin is like the difference between this stock price plus the premium. I mean, it's a pretty damn good return. And the interesting thing is if you wrote this option and you bought the stock in the marketplace, well, you're basically reducing your average cost on the stock by whatever premium you collected. So in a weird sort of way, by buying the stock and writing this inflated call, you're reducing your cost basis on owning the stock dramatically, building in a cushion for you, if you will. And of course, if the stock actually gets called away from you at 55, you've got a home run in returns. So does everybody understand why this strategy would be so attractive? And the bottom line here is this is like probably 80-90% of all stock transactions that involve options are basically the covered call strategy. And I wanted to introduce, did we find this guy? Because I remember this link didn't work, did it? But this guy, the blue collar investor, maybe he's still here. I think an excellent starting point if you want to learn the covered call strategy. Guy like you, Bobo, I think that you could do very, very well because if I'm not mistaken, I think you're sitting on a half decent size asset base. And if you can get this concept down, it's a great income generating machine. And it's really simple, really, really simple. So hopefully this demonstration showed to you the power of the covered call strategy. And also, too, the importance that if you're going to be writing these covered calls, you want to try and concentrate on assets that are bid up. Because, writing the covered call in depressed markets doesn't really work, right? Because it's all about implied volatility. We then wanted to, in the writing of options, we wanted to shift gears and not talk about the calls, but we wanted to talk about the puts. And it's important, definitely a question on the exam, to know that most options are not written by individuals. Actually, let's back that up. Most put options are not written by individuals, but written by institutions. Obviously, if you write a put option, then that means that's an open-ended obligation to buy that asset. And it's understandable. A lot of people don't want to, in this business, this is the only business when stuff goes on sale, nobody wants to buy. So to think about writing a put to actually buy stock is completely contradictory to retail's thinking. It's exactly backwards to retail thinking. However, if we start looking at the market, especially through the level one, introducing you to the idea of using fibs and institutional fingerprints to try and force yourself to buy into down markets, well, now this information becomes extremely valuable. Because what often happens, of course, is that institutions, because they can buy the stock and they can keep buying if they have to, they have deep pockets, they can start writing serious put options at where they believe intrinsic value is for the particular asset. Does that make sense, guys? A super important concept. We can take the trade with them, or we can just simply use their fingerprints. And, as we sort of pointed out through the course material there, and did anybody go through this process? And just pull up, anybody, give me any stock. I don't really care. It doesn't matter. Somebody give me a random stock. We looked at Boeing. Yeah, let's do a different one. Somebody give me a random stock. I don't even care. Let's go Microsoft. MSFT. That's pretty random. Boom. And I would recommend, especially if you're looking at stocks, that you look at the big contract months. So you'll notice, like here, we, for this April expire, we got 4,400. Then you notice that, wow, okay, they dropped down quite a bit here. So obviously the April contract has a lot more open interest than, say like this May contract. You can see how thin it is. If we go out to the big May monthly contract, you can see there's a bit more open interest. But June is usually, it's also got a futures contract associated with it. Can you guys see the big June monthly contract? Look at the difference in open interest size. Can you see that, guys? June is a really popular contract. So, to do this analysis appropriately, we should be looking at the big quarterly contracts. So keep that in mind, guys. But in essence, if I go and look, and this is Microsoft of all things, right? If I go and look at that June big quarterly contract, can you see? Who can tell me, looking at this screen, I won't give you the answer, but who can tell me, where does it look like that the institutions have the heaviest open interest on the put side, which is really interesting because this is pretty expensive. Where is the heaviest open interest in this thing? Anyone? Do 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 do. You want me to zoom in? There we go. Where is the heaviest open interest? 95. That's right. Right here. 95, which is interesting, eh? Because a lot of stocks we see, well, 97? No, I don't think so. Where do you get 97? I see 97.50 here, but I don't see a 97. But this is interesting, right? I think this is really interesting. This basically implies that this street would be more than happy to be a buyer at 95 bucks. I'll just be curious. Let's see what this thing looks like. What's really weird is, man, Gates has been selling just a ton of this stock over the past year or two. Well, it's sitting right at 95. So the street basically believes that the stock is going to be here in June. And I hate to say it, guys. Oh, that's hourly. Let's go to daily. Does it? I guess it kind of makes sense, eh? I mean, is there a letter of the alphabet here? Down, up, down, and then even up, down, up. That's interesting. The powers that be are definitely going to want to encourage this stock to be above. 97. Isn't that interesting? So they expect this stock to be well above 95 bucks in the June, which is surprising, eh? Jesus, look at that chart. That's actually a bit of a surprise to me, guys. It's a bit of a surprise. But if anything, maybe that kind of makes sense, I don't know whether we should be thinking about stock market crash now. All right. So, and this is why this is handy information. Now, also too, did you guys notice where was the heaviest open interest on the calls? Anybody see that? Should I go back and show you? Now, isn't this interesting? Not many that on the long side here, but notice there's 95. Look at all the option open interest above 95. Do you guys see how it's basically in the street's vested interest to just park the stock right at, and you can't really do it that well, but right at 95, maybe like 94, 99, eh? Wouldn't that be incredible? So let's keep an eye on this if you want sort of a fun assignment into June, which is probably going to be around when we're going to be doing our final exams. So does anybody want to watch this one? Kevin, remember we did the S&P one with you last week, and notice that they couldn't even bring the market back up into that option level, eh? So I was saying repeatedly on the daily briefs, I bet you Wall Street's going to be heavy long a lot of stock. But hopefully when you look at this open interest, you can see, wow, there is a huge vested interest in them keeping price below, above, I think is the answer I'm looking for, 95. And there's also a heavy vested interest in them keeping the market below. Did I get that right? Below calls? Below 95 here. So all of these calls expire worthless. And above here. So all of these expire worthless. Which is interesting, because there's pretty heavy open interest here on the calls here. I bet you there's a lot of people who wrote this that would really like that to expire. And that's $100 too. That's a big fat round number. So. Interesting too here. This is only under 19,000 contracts. And yet look at how heavily the calls are. 50,000, 34,000, 51,000, 22,000. That is a shitload of call options. My hunch is there's no fucking way they're going to let the market close above here and let all these options expire worthless. So my hunch is they're probably going to finish the market right around this 95 level into June. So let's keep an eye on that. We'll make that sort of a fun group assignment. Bobo, you're really good at tracking these things. So let's keep an eye on this for June and see how it goes out. So I will take that and we'll put that there and we'll put that there and we'll put that there. So we'll keep our eyes peeled. Okay, so really important that we understand the important information about option open interest. Super, super valuable. And specifically with regard to the put options. Wherever the heaviest open interest in the put options is, odds are that's basically where they're probably going to park the market into that expiry. The second part of our option writing strategy was looking at ways that we can use options to actually buy stock. We want to be owners of stock, and we are going to use the option to help us finance the purchase of the stock. In fact, if you do your screening well enough, you can actually find option premiums that are so expensive, they will not only finance the ownership of the stock on margin going forward, but they may actually even pay you a premium on top of that. And that's this whole concept of the WDB option screening module. And we gave you a really simple illustration. Super important here, critically important, that if you're going to use this strategy on commodities, that you make damn sure that you consider this at or near or even below cost of production. So does it make sense to do a Bitcoin option strategy with Bitcoin at $20,000 a coin? No fucking way. And really, I'm not even quite sure what the hell the cost of production of a Bitcoin is, but we don't even have options on Bitcoin yet, even though it's trading a futures contract on the Chicago Board Options Exchange. Like that makes any sense at all. But one day when we do get options on Bitcoin, should be good reference for you, for your notes, for your logs going forward. We only want to consider writing put options to actually be buyers of commodity-based proxies at or below the cost of production. It's almost, it's very similar to the silver options insurance plan. You do not want to think about buying options on a commodity that's overvalued, because those, the call options with the anticipation of price going up, those call options could very easily expire worthless if you buy overvalued assets. So same sort of thing here. We're going to, because we are writing a put option, we fully expect to get exercised on the option, but we want to own the stock. That's the whole point of doing this to begin with. We want to be buyers of the stock, so you have to make damn sure that the stocks that you do consider are trading at absolutely ridiculous fundamental valuations. We would then want to apply some very basic technical analysis to come up with upside objectives. And then finally, just as we sort of did with the TRI-SOF, but this is sort of backwards, we're going to use this options premium formula to validate that, yeah, indeed, this is a good idea. Because as we said many times in the past to you guys, a good idea is a good idea is a good idea. If you can find 3 legitimate reasons to consider taking a trade, you can often find 4, 5, 6, and 7. So here is yet another completely unrelated reason to consider justifying risking your hard-earned money in the marketplace. Did anybody have any questions about the mechanics of the WDB? No? Did anybody try and look for any WDBs? No? All right. Well, I would strongly, as a part of your educational process, just take it in, but you don't have to trade these things. But, force yourself while you're in this program to go to that uncomfortable place and just spend maybe a half hour, 45 minutes, just one day a week doing Brian's crazy exercises. This was an example that worked out absolutely textbook. It was absolutely, couldn't have asked for this scenario to play out better. You can see the very natural technical bounce. While we were owning the position, basically our financing costs were paid for by the premium, and you even got a little bit extra on top of what we call getting paid to own positions. The stock took off, hit its natural criteria, doubled in price. We were able to sell half on a double, clean up the margin position, and basically establish a risk-free trade going forward. And really, ideally, guys, I'd love to get all of you to that point. That's sort of the whole sell half on a double. If you need to sell 3/4 on, say, a 50% return, what we ideally want to do as traders is get that free look where you don't have any risk involved in owning this asset going forward. So this is just yet another example of way we can get a free look on assets. Brian, did you say that your dad used this strategy? Yeah, to great success. In fact, the whole reason why I built that 1980s website algorithm site was we were going to go into business and we were going to run this portfolio. And unfortunately, our relationship fell apart. But that's another conversation for another day. But yeah, basically, this is what he does to make money. Can you imagine 2 Brians in the same room? Oh, God. Doesn't work. And the worst part about it is if we, you know what? Let's just leave it. I'm not even going to go there. Okay, so that's sort of the review, right? Now let's talk a little bit about some of the extra considerations that we need to have as options traders and really sort of the big takeaway of what we wanted to talk about today. I want you now going forward to think of volatility in a different way. In the level 1 course, you were introduced to this concept called implied volatility as just a simple way to measure whether the public's freaking out or the public is complacent. with the thinking of TRI's SOF, does this now make more sense to you guys? TRI, in essence, TRI SOF is in essence forcing ourselves to only consider buying options when the volatility index is very low. Right? This is basically implied volatility, and the market is complacent. That's right. What I'd like for you to do now, though, is I want you now to take your thinking to the next level. Does it make sense, understanding our idea that the institutions establish floors and establish ceilings through the writing of put options? Does it make sense that we can apply that same thinking to the volatility index? So in essence, institutions can tell you ahead of time where they expect volatility to bottom and to trough, right? Trough and peak. Does that make sense? We can look at the open interest of the options on the volatility index, or in essence, does it make sense that these options and their relative intrinsic values is in a way like the gamma? The options themselves are like the gamma of the volatility index. Or in essence, the options themselves are the derivative on the rate of implied volatility. This is now we're getting into conversations that we're just like, we're now taking it to the next level. And it's actually interesting. Warwick's the only one that I fried his brain on that. If you can get this concept, all of you should be like, holy shit. What you're really saying here, Brian. Hey, Thomas, nice to see you, Slick. In fact, Thomas and I, we talk about this in the daily brief. I've gotten them all jazzed about another volatility index series of options. Isn't that interesting that you popped in here just as we were doing this? Oh, it's obviously fate. But what I want you thinking here is, remember, volatility index is a function of human behavior. Humans are freaking out and they're bidding up prices. Humans are getting complacent and they're letting prices come down. But what we need to understand is that the institutions already pre-establish floors and ceilings in the human behavior index. So there, in essence, we can use the options open interest in the puts as our sort of benchmark for where institutions are going to push the market. And in essence, what is fear in the public skies? So as a special assignment for you guys, I want you to start studying and, again, applying TRI-SOF, and then applying the open interest theory to the volatility index's options. Are you up for the challenge? Anyone? Warwick's up for the challenge. Everybody else is like, boring. It shouldn't be, right? This should give you a hidden sneak peek, sort of behind the curtain, right? The wizard. You could argue that studying the open interest, and it's interesting because Thomas was commenting about this trade. Playing the volatility index was getting really crowded by the public. In that, and just in this particular example, the public was getting very complacent and just believing the stock market was going straight up, and just writing the calls, if you will, naked, selling that VIX index because it was just assumed that the VIX index always goes down. And then just recently in the stock market, of course, the VIX went nuts. And, Thomas was telling us about how, through this spike, how, there are other stock market proxies that are like ETFs off the volatility index, how they like destroyed themselves and people lost fortunes. So if anything, what I'd like for you to do, and this should be a really good exercise too, sort of dovetailing our assignment of going and finding options charts, I'd like for you to see if you can find these options charts as well. So see if you can correlate bottoms in these options prices on their charts relative to the heaviest open interest in the given contracts. Does that make sense, guys? All right, Warwick's all over this. Everybody else is like, I think I'm going to have to go watch this a couple more times. All right, yeah, I mean, this should be a fun exercise. And the point here is, if you can get your head around this concept, now you start becoming like a trader like Thomas. I think Thomas is sort of like TRI's flagship of what we all sort of want to aspire towards. So thank you, Thomas, for being such a good role model. What have I done? Yeah, you got yourself into hot water, buddy. But if I'm not mistaken, and now all of you guys are basically privy to this, all of you guys should be and Thomas even quarterbacked it. And, just a heads up, guys, I don't want us staying on Telegram. Telegram was just supposed to be a stopgap measure until the boys got the new website up and running. And here is the end of fucking April now. So eventually they'll get it up and running. But all of you guys now, you should all be in this group, right? So if you're not, this group was actually put together by Thomas. He's sort of quarterbacking it. It is sort of like the derivatives trading group right now. And if you have an interest in this, I don't know whether did you make me so I can add people? But all of you guys should be in this group now. I'm not quite sure how to do this though. Do you have the join link handy, Thomas, now that you're here? There is a way to do this, but I'm not quite sure how I do it. Create invite link, create invite link. Okay. Did that do it? Create an invite link. What happened? Telegram. Oh, there it is. I think it's been a half an hour here. Anyway, there you go. Thank you, Thomas. So, if anything, what I would like to see for you guys going forward, there's Warwick, he's already in, is let's start posting these ideas and these assignments that I gave you guys, okay? And the cool part about it is, Tom is very active in the options market. If you post a half-decent idea, my hunch is he's probably going to take it. Hi, Ian. Welcome. So, Bobo, if you could get your butt in there, I think that's a good place for you to be too. Okay, and all of the rest of you guys. I mean, I'm not excluding anybody. If you're interested, get your butt in there. We talked a little bit earlier about the smart money and the way they use put options. I think this is fairly straightforward, so I don't think we necessarily need to go back into that again. Technically, swaps are derivatives, but I don't necessarily go into trading swaps in this education program. If somebody asks you, is a swap contract a derivative? The answer is yes. Because in essence, the definition of a derivative is an asset that derives its value off of another relationship. And so in essence, a swap is nothing more than a contractual agreement between two parties to quote unquote swap assets, and there is a fee or a premium for that swap. I'm not really going to go into too much detail about how to trade swaps and how to use the information in this course program. I would just simply say, as with any of our technical tools, we want to hunt structure, we want to hunt divergence, and basically all of the same rules that we use to hunt, W's and M's and setups in the market. Technically, you could use them in the swaps market as well. The interesting thing for you crypto enthusiasts is you actually have a much more intimate introduction to swaps, especially for those people that sort of started their crypto experience on sites like Bitfinex, which in essence created a peer-to-peer lending system. And that peer-to-peer lending system is in essence what swaps are. Swaps, what's interesting is you can even have derivatives on swaps. So, we can go to things like this. And actually, probably the best place to show you is the commitments of traders reports. Maybe I'll just go to CME. But when you see, like here they have a 10-year T-note futures product, 5-year note futures product. Now, you might own like a corporate bond or even like mortgages, right, which technically are bonds. But you don't want the risk of owning the corporate bond or the second mortgage, a residential bond. So you actually can go into the interest rate market and you can buy swap futures. So in essence, this is a derivative product on a derivative. And then just to fry your brain, but it doesn't look like they're going to let us. They should, but they don't. You can technically buy options on futures contracts on swaps, which is like a derivative on a derivative on a derivative. There is no intrinsic value to any of this. Well, the great analogy, of course, is, maybe Warwick rent that movie, The Big Short. So in essence, that's basically what he did. All right, so you've seen it. So in essence, he was, yeah, well, exactly. Good point. He was in essence saying, I believe that residential mortgages and the risk of default on those residential mortgages was what was not being properly priced into the market. And the spread between a U.S. Treasury, 5-year, 10-year, whatever, and those residential mortgage futures contracts was just too narrow. So in essence, I'm going to go and sell the residential mortgages, but I'll buy the government bonds. In essence, I have a net neutral position. And if that spread widens, then I make money. And of course, when the residential mortgage market collapses, obviously that swap goes, the spread, right, goes through the roof, and he makes lots of money. Okay. And isn't that funny how just an old gnarly veteran, right? If you just want to keep it as simple as possible, sometimes the explanations of how these things work is relatively simple. It's just that people end up just overcomplicating it ridiculously. As I had said before, I don't really think it's in any of our interest to get involved in the swap industry. But if you want to do like futures contracts on swaps, that's not a bad idea. I'm actually a bit surprised I don't see options on these things, but there should be options on these swaps as well. But that might be OTC, and I don't know whether there's exchange traded options on swaps. This is a good question. But the interesting thing for you guys is, ironically enough, you're actually introduced to this concept of swaps. And full disclosure, the derivatives licensing exam is a fucking pain in the ass. It's like twice as long as just the regular futures licensing, and most people fail it. I've actually written the derivatives licensing exam, the options licensing exam. I've actually written the course a couple times, and I passed both times, so I felt pretty good about that. But for the exam, just full disclosure for everybody, I when I was studying for the exam, I just said, fuck it. I'm not even going to bother getting into swaps. It's just too much of a headache. It's incredibly complicated, the math that they use to create swap arrangements. What is the ratio of this bond you have to sell versus that bond? And, taking into credit quality of the different bonds and shit. I'm not going to go into it with you guys. It's just too much of a headache. And frankly speaking, I don't think any of you guys are ever going to trade those markets. Well, it's risk mitigation, just kind of like your Big Short. If, they were handing out second mortgages and stuff to people that didn't even have jobs. So what is the likelihood of somebody going to pay back that loan, right? A mortgage, all it is a loan. So if somebody doesn't even have a job, what's the likelihood that they're going to pay that loan back? Versus what's the likelihood that the U.S. Treasuries, that the U.S. government is going to pay that loan back? And at the very height of the George Bush Jr. days, before the financial asset crisis, do you remember what the rhetoric was? The rhetoric out of George Bush Jr. was every American should be a homeowner, right? Which means you have a mortgage, right? And you own your home, which you really don't. The banks do. So everybody was getting home loans, regardless of whether they could pay them back or not. And it was all guaranteed by two agencies called Fannie Mae and Fannie Mae and Freddie Mac. So, if anything, this is a great lesson. If you ever hear about a government guaranteed program, at some point, some unscrupulous capitalist, think of like Nubits right now in crypto. Does it make sense that when Nubits comes out and says, we absolutely guarantee a parity 1-for-1 with the US dollar, do you see how that sort of paints a target on their back? Where people are going to be like, all right, let's see, let's test them. Well, same thing. When George Bush and all his, keep in mind, these people are fucking stunningly corrupt. When they see that this government agency will absolutely guarantee this paper, do you think they're going to go and start lending out paper to people that really don't have any business taking out mortgages? They've got no downside risk. The government's going to guarantee them. So they go and just write shitloads of mortgages to people that really have no business whatsoever taking out a bond. The government's guaranteed, Freddie Mae, Freddie Mac, blah, 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 blah. And the market gets distorted. At some point, the market goes, whoa, this is ridiculous. And then they test the U.S. government. Well, let's see if the U.S. government really is going to make good on this guarantee. You see how that works? It's pretty straightforward. And you could argue, just like the relationship with, in crypto's case, right? And like I said, you guys are kind of lucky with regard to swaps. You actually have a working model to learn this by. If you go to the Phoenix site, you will see that there is a running rate to borrow US dollars. And there's a running rate to borrow Bitcoins. And in essence, these rates go back and forth, and the relationship between the rates is basically a swap agreement. All right. As I said, I'm not going to go into too much detail on swaps, and I don't really quiz you on the final exam on swaps. If you want to have a conversation about them in your tutorials, that's fine by me. But the real purpose of this, yeah, I know. I could, like GAN part 3. I'm sure a lot of you guys are like, did you guys look at the material that I put together for the level 2ers this term on GAN? I know a lot of level 3ers and even alumni have been coming going, Brian, do you mind if I have a copy of that updated GAN material? So that could be a whole module. And I suppose if there was a level 4, I could do a module on swaps. And actually that brings us to the next concept. One could argue that there are derivatives. And remember, I told you at the beginning, I told you an hour or two ago, I don't know when it was. There were options, even in W.D. Gann's day, to trade things like corn and wheat and stuff, but they were OTC. We need to understand that there are many different types of derivatives in the marketplace that actually trade very much like stocks. They're not options, and they don't trade on options exchanges, and they're not cleared through a clearing corporation. They're actually listed on stock exchanges as equity participation securities on their own. Do you guys remember in the level 1 program? And let's see if we can quiz you. What are the 3 different ways that insiders can participate in stocks? Oh, no. Oh, he didn't just say that, did he? Not quite, Warwick. It's a little more detailed than that. Does anybody remember? Oh, Jesus. He didn't actually ask us a question from level 1, did he? Crickets, yeah. Look at the silence. Seriously? Oh, boy. We said that insiders could get long through things like options to directors, right? Does it make sense, those options to directors? Options. Oh, geez. Doesn't that word sound somewhat familiar? Options? That's what we're doing right now? Do you see the connection? All right. We also said that they can go and just buy open market activities. And remember our story about Nortel? And the guy, he had to go around because he owned more than 5% of Nortel. So because he was selling his stock, he had to go around and make public disclosure. And everybody in the public, of course, made fun of him. But who's laughing last, right? What was that 3rd way that insiders can participate in the market? Anyone? No, that's open outright activity. Open market activity. That falls into that, Kevin. Participate in something. Oh, boy. Participate in financings. That sound familiar at all? So, remember we said that, and let's see if, oh yeah, of course, Keith. Let's say that we participated in a company financing. They were raising $1 million, and I went and bought 100,000, 10% of that issue. Was there any commissions? No commissions at all. So, if your broker's going to charge you 2%, and I'm buying $100,000, well, that commission's $2,000. If I participate in the financing, I deal directly with the company, no commission. Do you understand why there's incentive to participate in financings now? As well, some financings, they have tax treatments. All right. Have any of you, what is the popular name? Greg, you should know this. What is the popular name for financing? Aaron, are you here in Canada? I can't remember whether you're here in Canada. What is the popular name for financings? In the States, they do it to a certain degree. No, ICO. No, you're totally going in the wrong direction. What is the name for the financings that are done that have special tax treatment to them? 2 words. First word starts with an F. Second word starts with a T. Flow through financings. Anyway, that's a whole other conversation for another day. The point here is that, well, special tax treatment. Let's just say that, okay, Warwick? But a lot of companies will throw in a sweetener to even make it even more attractive to participate in the financing. And they might even go to existing shareholders and say, we're trying to raise some money. We will give you the right to buy more stock at a certain price. It's a special treat to existing shareholders. They're called rights. What did we say was this special bonus treat that is often included in venture capital financings? It's right on the screen. Read the screen. Warrants. Warrants, in essence, and what usually happens is a company will say, all right, for every 1 share that you participate in the financing, we will give you a half share purchase warrant. So in essence, if I did like $1,000 in business, then they'll give me a warrant to buy another $500, right? 2 warrants, 2 half warrants goes into 1 full warrant. I can buy 1 share with 1 full warrant. So they'll give you like a half share purchase warrant that's attached to the financing. Warwick, they said after class, I want you to go and find 5 different financings off of the TMX website, and I guarantee you every single one of them will have warrants attached. So in this particular case, Hudbay Minerals did a financing, and they raised a bunch of money, and they had warrants that were attached to the financing that had a pretty long expiry date, like years down the road. Think of Leaps, same thing. But these warrants can actually be listed on the exchange. Yeah, well, maybe one day you can. Who knows? All right, let's first get options, okay? So these warrants and this particular financing, it was so active that they actually listed the warrants on the exchange themselves. And in essence, these are basically exchange traded options. And they will trade on the exchange until expiry. Does it make sense that in essence, there isn't a lot of difference between an exchange traded warrant and an option? Obviously, the warrant gives you the right to buy. So we don't necessarily have put warrants. That doesn't really exist. But in essence, a warrant traded on the exchange is exactly the same thing as a call option. So here is an example where you could have gone and bought, in this particular case, the stock's $9.74, or you could have gone and bought 1 warrant. In this particular case, the strike price is a little bit far out of the money. But does it make sense, number one, If I wanted to buy the stock, I'm tying up, let's say it's 100 shares, I'm tying up $974. I could go and buy the same warrant on 100 shares, it's 92 cents a piece. And in essence, I've locked in that option at a fraction of the cost. Yeah, exactly, Bobo. Exactly. But do you see how I don't tie up all my capital? I just have a fraction of the capital cost, just like an option, right? If I could buy Microsoft stock at 95 bucks a share, or I could go buy the, $95 call option. As well, too, notice, look at the volatility and the price of the option. This stock was as high as $12.50 and as low as $9.50. Oh, that's okay. It's like $2 or $3. At the same time, this option was as low as, this warrant was as low as 80 cents on this dip and as high as $1.90 at this peak. So can you see that, just like the options, there's a lot more volatility in the warrant price. So not only are you participating in the stock and you're not having to put down nearly as much capital to control the same amount of shares, but these things are also much more volatile because, of course, they're options, right? What do you think? Up here, does it make sense? Probably a bit of an implied volatility in price here and implied volatility coming out of price here. Does that make sense? So the point here is we wanted to introduce you to exchange traded derivatives. And there are lots of people, just like our covered call guy, there are lots of people that just make a living out of trading warrants. No, you're not going to load. Fuck. I swear. Half of the time when I load these damn sites, they don't load. Anyway, this was a really great. I don't know if I spelled that wrong or not. It was a really great resource, but obviously you have to spell it correct. WARR. WARR. ANT. Are we going to get anything here from these clowns? Maybe they took it away. That's too bad. This used to be a great resource. What the hell are they talking about here? All right, Quebec or ends warrants higher valuation as telecom pure play analyst. So you can see, but these guys, they used to actually have a nice list of all the warrants that were available. But here you can see, right? Gold Wheaton warrants get clobbered. There's a lot of people that just simply play the market through the warrants business. But I wonder where blockchain. Isn't that interesting? Even these guys are following block. There's probably going to be warrants coming soon enough on blockchain. But let's see if that's too bad. These guys used to have such a great list. Fridge. I hate how it's silly internet. It's like it comes and goes. Sometimes it's good. Sometimes it sucks. What I want is, where do you think we can find this? I'm thinking maybe over here. Oh, isn't that weird? It's just not loading. Oh, that sucks. Oh, well. These guys used to be really good. Arrest warrants. No, that's not quite what we want. Okay, stock warrants. Ooh, this is Canadian. Anybody who's in Canada, anybody who's in Canadian here? Look, they even give us the Financial Post goddamn site here. Look, they even say do exactly what you did. Oh, come on. So what they did was they probably changed it into a paid fucking subscription service. That sucks. Well, anyway, and maybe what we'll do is as a fun assignment, I'll sort of poke around this evening for this, but really we should have a list here for you. Where to find a list of welcome. Ooh, look at this. Welcome to Canadian warrants. Here we go. What do we got here? Score. All right. So fun experiment, especially those people. Is this the one that you just found, Greg? It is. That's funny. So, you're going to have to do it in your own country. Look around, but the Canadians, you get kind of a lucky break. Americans, not a bad idea for you to do this and then see if you can port this down into the States. Yeah, I wouldn't be surprised if you could find references for the States. So here's an example where there's tons and tons of companies that have warrants listed, right? If anything, look at that. They even got U.S. warrants here, right? U.S. warrants. So, do yourself a favor and just peruse through this and just introduce yourself to the warrants listed on the exchanges. It looks like I've included interactive brokers, but I mentioned, okay, so is this for the States? All right, so do you see how it says warrants here? And good. All right, so we can even look at all the warrants on just these big U.S. companies, right? Bank of America. Has anybody ever heard of that before? So you can see that there's warrants listed on tons and tons of stocks. Okay, so why would you do warrants? What did we say was the absolute number one reason why you would do warrants? No commissions. Yes, because you're dealing directly with the company, right? Friendly terms. Keep in mind that these are sweeteners quite often. Just like leaps, most warrants have very, very long durations. They're not going anywhere anytime soon. And of course, just like this example, you can actually play the market just on a fraction of what the underlying is. Does anybody have any questions about rights and warrants as examples of derivatives? No? All right. Okay, before we sort of wind up today, a couple things I want to just talk to you about. When it comes to derivatives, we have to understand that there is time value decay here. And it's important, I'll definitely ask on the final exam, how do you approach this thing called the roll? Ideally, like we said, if we're long options and, remember our silver options insurance plan, we introduced to you a few weeks ago. You've probably forgotten most of it now. But nonetheless, through the silver options insurance plan, what we really want to do is break apart our capital into equal lots and then just maintain the 4 furthest out contracts possible. And then as time goes by, just simply roll the closest one to us out into the next furthest out option. And ideally here, we would like to not be in an option with less than a year of life left. So, ideally every, few months, we're going to, we're going to be buying leaps, and ideally we want to buy leaps with a couple years of life. And as we get closer and closer to those leaps coming into a year of time, especially, with our image here, we don't want to be anywhere near being long an option when we start getting less than, like, say, 120 days if we're thinking that silver options insurance plan. Which, again, like I said, the irony of it all, when Kenny Roberts, he would go and buy the 6 month, then next month buy the next 6 month, then the next month buy the next 6 month. So by the time he's at the third one, the first 6 month only has about 90 days of life. And so at that point, he's going out selling this 90-day option and rolling it out into the 6 months. Because of leaps, remember, this was written before leaps were even on the scene, right? This document, this was written probably a good 10 years before leaps were introduced. So the cool part about this, right, is that, playing the deltas, you can dramatically expand your returns, as soon as the market sort of moves in your favor. But the downside is that these derivatives have a life, and we have to make damn sure that when we start getting into sort of the window of time value decay, that we're going to roll out of the near term and put that money to work in the deferred contract. So the key here is, as I had said before, especially when it comes to like the front month, and it just gets evil the way this works, is like, let's say, here we are, the end of April. So we just had the April expiry come and go. So now the May contract is the next front month contract. Does that make sense, everybody? Okay. So ahead of that April expiry, let's say that's like right here. There, if you looked at the sheet, the front month would be April, and then the next deferred contract would be May. So as a result, our time value decay, if we're long the Mays, won't be that big of a deal. But as soon as that April expires and now May becomes the front month, if, let's say, we're long calls and the market puts in like an M or something and starts to even slightly break down, whatever implied volatility, whatever time value in that May option, because now it's the front month, it will just collapse. So rule number one is we don't want to be anywhere near this part of the curve. Ideally, if we're going to do our roll, it's going to be way out here. Super important, guys. All right. We also need to understand, too, that the market itself, because of all the participants not wanting to be part of this, the market itself will thin out dramatically. Open interest will start to contract. And then if you're a motivated seller and it's a really thin market, you get even more screwed. Now, at expiry, if we're thinking about, so, because the market, because of time value decay and because the market thins out, we do not want to be part of this if we're in the roll. At expiry considerations. Now, we have to be cognizant of the fact that if the option expires a nickel in the money, it will be automatically exercised. So we definitely, if we don't really want to be long the asset, we better get the frick out of there. And usually options expire the preceding month of the futures contract. And there's even like first notice days. So they will start sending out notices that, hey, your option's getting close to expiry. You better be careful, because if this expires at all in the money, it will be automatically exercised. Most of the time in that auto exercise, it's not like they're going to deliver 5,000 bushels of wheat. Usually nowadays what it'll be is it will just be a line item notation and accounting ledger notation. But that can still be pretty darn big money, right? Kind of like the Bitcoin futures contracts, right? They are cash settled right now. Warwick, do you understand how that works? If you go and buy a Bitcoin futures contract, you hold it to expiry, you do not get Bitcoins. You just get a line item notation on your account sheet saying credit him X amount of dollars, right? Or debit him X amount of dollars. Does that make sense? All right. At the same time, too, though, we need to understand that if you write put options, you have the right to actually ask for stock. And if you write call options, right, the person who buys the option actually does have the right to deliver you the stock, and you have to buy it off them. But you have to specifically specify that. So please understand, if you do write the put and you want it to be exercised, you have to let your broker know that, hey, I want to get exercised. I want to own the stock. Don't just cash settle me here. As I just said a moment ago, once we get into that nearest contract expiry, theta will just collapse. So we really don't want to be in that nearest contract. That is just dangerous. And of course, if you're writing options, this is exactly where you want to be. Now, with regard to the roll, right? Let's say I'm long a January 2019 silver call option because I'm doing the silver call insurance plan. We're coming up on 6 months here until expiry. How do I roll out of this thing? You have to, because options are derivatives, right? They will trade on the tone of the market. So if silver is up on the day, then people will pay the premium for the calls. But if silver is down on the day, you could put your offer on the floor and nobody ever hits it. They don't have to trade it. So if you are in a long position, you have to try and close your position on an up day in the market, because those are the days that people will pay up for your premium and you're on the offer trying to get out of the option. But don't go on the day, let's say it's an up day and you get filled on the offer. Don't go on that same day and roll the position out into the next contract, because you're going to be paying up for that premium as well. You're well advised to work your bid on that deferred contract and wait for a down day. Down day, people will be hitting the bids and you'll get your fill. Might be a little bit complicated, and if you need time to work through this and understand the logic behind it, it's totally fine. And my suggestion, of course, is, to do a few paper trades to get good at this before you risk any money at all. Trading the roll can get a bit tricky, and of course, it's everything about emotions. And as we said, because of implied volatility, it's just in essence all emotion. You can get sucked into FOMO and wrecked thinking very easily and very quickly in options, and you got to keep a level head. One thing I'd absolutely say about the roll, and this is where most of my retail clients ran into trouble in the past, is they just don't understand that, let's say you're doing the silver options insurance plan and you're like, 6 contracts into this and you're still waiting for the market to turn up. You have to understand that part of the cost of doing business and a strategy like this is you might have to take small losses on these rolls. You might have to bite the bullet a bit. It's totally realistic until the market actually gets going, and then you start making money. And the way that you have to look at it is, well, this is just part of the cost of doing business in this very highly leveraged situation. Of course, to maintain that roll, to maintain that position, you're going to have to absorb a bit of the roll. If this market takes off, then you're going to make so much money, you're not going to know what to do with it all. In those kind of cases, people are more than happy to accept the fact that, yeah, I'm going to have to forego some premium because of the cost of doing business with the roll. It's just the way options trading is. And really what I used to suggest to people is, if we are in one of those silver options insurance plan scenarios, don't look at the individual price of the options as your cost of doing business. Number one, you've got a number of contracts spread out across the calendar. You've probably been having to roll a few positions out. What you really want to do is you want to try and think of it as your cost basis for the position. Okay, having said all that, I think, it's a good idea to have a checklist if you're ever thinking about doing derivatives trading. It's really easy to lose money here. So, obviously, you guys, I want you paper trading, but even if you're at the point where, okay, I'm actually ready to start trading derivatives in earnest, whether they be warrants, rights, calls, puts, or even swaps for that matter. And there are a lot of people. There was one guy on the site a couple of years ago who used to love trading the swaps on Phoenix. So don't get me wrong, people do it all the time. But it's a good idea to go through a checklist. First off, and I know it might sound silly, but especially if you have like about 10, 15 different options positions on, you can get overwhelmed really quickly. So just keep it as simple as possible. What is my objective here? You'd be surprised how people actually lose sight of what the hell it is they want to do, especially with spreads. It's remarkable. Like my old man with his WDB, he'd have so many, naked options positions going on. And I would ask him, you got like 4 or 5 different naked positions. Hey, absolutely, Warwick, you definitely need to make a trading plan for this. No doubt about it. But I would say, do you really want to be that concentrated in the gold market? You got like 4 or 5 different positions going on. And he'd just step back and go, you're right. Maybe that's a bit heavy. So I always think it's a good idea just to start off and ask yourself, what is it I'm trying to do here? What, on a daily basis, same thing in altcoins and the shitcoins, right? Same thing. What is it I'm actually trying to do here? And you can lose sight of that objective with derivatives very quickly. Again, am I getting in over my head? If you got 5 different naked put options on one sector of the economy, and that sector moves against you, you might be getting in way over your head. Then also remember Mr. TSC and the stupid UBC and global securities. That guy got in way over his head just because writing the options was just so easy and the money was ridiculous, and he ended up almost blowing up the firm. Think it's a good idea just to remind yourself, what is TRI's secret options formula, and does this option meet that criteria? Always ask yourself, if you are interested in buying options, am I buying enough time? Time is the trap here. And most options ideas that fail, from the long side, it was just simply a function that people didn't buy enough time. And then finally, always a good idea to keep risk in mind. Obviously with writing naked calls, and naked puts, it's open-ended obligation. I don't think any of you guys really probably are interested in that. The good part about being long calls and long puts is you definitely know your finite risk on the trade. It's just the purchase price of the option. But, again, do we want to keep an eye on concentration? Have I got too many options going in one particular sector? Only after an affirmative from each and every one of these questions can I even consider an options transaction, or even really derivatives transaction for that matter. So, I would definitely agree with what Warwick just said. It's not a bad idea that if you are going down this route, you actually have like a sub plan. Step 1 is to go through my whole trading plan, identify my setups, trade location, divergence, structure, blah, 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 blah. If I'm considering doing the options route, step 2, go to the options trading plan and go through that screening criteria. Does it meet TRISOF? Am I taking too much risk? Am I buying enough time? What are implied volatility premiums? What's the price of the option going to be at my target price minus strike? Blah, 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 blah. Okay, gang. Well, that sure was a mouthful. Hope you guys enjoyed that. You have now been formally introduced to options. Yeah, it might take a few goes at this. You saw Spencer was here. Obviously, it was such a dry conversation. He took off. I don't know whether Thomas is still here. Thomas, are you still around? Did he stick around? I see a T. That might be T for Thomas. Hey, there he is. Cool. Giving you a whole bunch of fun sort of little side assignments. Yeah, no doubt about it. And if you want to come back next term and join the gang and go through it all over, by all means. Yep, absolutely, Warwick. You basically have the run of the place. Look at Thomas. I mean, he came in here totally uninvited, bastard. You got to understand, guys, if we've been working this long with you guys, you are actually extremely valuable to me. I want you to stick around. I want you to come back. I want you to participate. You are an invaluable asset to me. So anything I can do to sweeten the pot to get you guys to stick around, please let me know. Well, not anymore, eh, Warwick? Okay, I think we'll probably leave it at that for today. There you go. Thomas, right on. So, I think the long and short of it here is we've got the derivatives group set up, and actually it's great that Thomas is here today. I think all of you guys should introduce yourself to Thomas if you don't know him already, and get your butt in that group. And really, we should really sharpen your tool belt here with the options. And at the very least, leave this program understanding how you can use options and the options information to help you make better decisions in the market. You may not even trade an option, but there's so much valuable information here that can really, really make you into just a phenomenal market participant. Okay, I think we'll leave it at that for today. Be sure to book those tutorials, and let's have some fun conversations with all the mini assignments I gave everybody. We will be switching gears in the next couple of weeks because I want to sort of walk you down off of the ledge here. So we'll be doing a bit of sort of review in a way for the next few weeks, but I really want you guys concentrating on this options material and working with Thomas and in the derivatives group to really get good at this shit. We're going to be taking a look at trading seasonalities next week. Then we're going to be moving on to looking at a topic that we touched on in level 1, but we really could do a lot more work on: intermarket analysis and things like the first 2 weeks of the quarter study and money flows and all that. And then we're going to finish off with a fun module on reading the tape and trading with the DOM. So, okay, I think I'll stop talking now. You all have yourselves a great rest of your afternoon, evening, wherever you are in the world. Be sure to book those tutorials. I really want to have those conversations with you guys. I want you to get good at this, and all the best. All right, the only thing left to say now is bye for now.